I'm David Baker, CFO of Elemental Altus Royalties Corp.
Dave, good to see you. In fact, we're making a habit of meeting abroad, aren't we? Given we both live and work in London. We're here for business, cold hard business. Up the road here, a bunch of companies desperate for cash. Some of them good, some of them not so good. What do you do about it?
Well, I'm very, very pleased to announce record revenues, 6th consecutive year of record revenues, exceeding guidance, which again we're particularly happy about. So $17.8 million US dollars of revenue, and just over 9,000 gold equivalent ounces. And remember, our business, those are zero cost ounces, so they're very good ounces.
They're very good ounces, but you're saying that in the context. Well, I'm trying to get at what do you do with it, right? So well done on the numbers. I mean, up through the board. Also, lowering G&A, just to be really clear about this one, you're becoming more efficient. You've kind of got a different employee profile as well, haven't you? You've changed.
Definitely. So I think what we did really well post the merger with Altus is monetize some of the exploration and prospect generation business there. So successfully exited and created incredibly good royalties and cash flow from those. And I guess that has a knock-on effect. So it is a bit of a lower headcount. So we will have materially lower G&A this year as well.
Okay, becoming very, very profitable. Revenues looking quite attractive. You can sit on it. But that's probably not what your shareholders want you to do, because I think there's some deals to be done out there, and there's some desperate companies looking for alternative fund. Desperate, they're good assets, but it's a tough market. But they need a solution.
Oh, definitely. And then that's one of the reasons why we're here and why we were in Cape Town is we are looking to deploy that capital. So next year we're looking at this year we're looking at materially higher revenue from a couple of new royalties coming online, and our shareholders want us to redeploy that capital. And we're into probably the 3rd consecutive year of pretty difficult capital markets for the explorers and developers. It's really hard to raise money, and we're getting more inbounds than we ever have on being able to find new opportunities to grow accretively.
Right. Okay. So this isn't like a showcase whistle stop tour for you saying look how good we are. We're here to do deals.
Oh, absolutely. Yeah, no, this is why we're here. So yeah, we've got a full BD team here, really out there looking for new royalties to redeploy capital. And I say we have a significant amount of liquidity. So in the bank, more than $11 million. We've got $20 million available on our credit facility if we need it. And then that grows every quarter. So we are generating cash flow that needs to be redeployed before we even need to go to the market.
Okay, so remind me what you're looking for. What's the profile?
So we look at everything. So we will look all the way down to explorers, developers. I mean, obviously, we would have a preference for cash flow. But again, if we've had more than $17 million of revenue this year, we don't need to overpay for that. We don't need to chase that. We're really looking for the best deals. So we obviously gold focused. That's very important to us. But obviously with Caserones that we acquired through the Altus merger, and then the Cactus royalty with the Arizona Sonoran. We're very fond of copper as well. But no, we'll look all the way up and down the development curve for opportunities.
Right, and there's going to be, I interview so many companies, and I see the good, the bad, the ugly, and it's quite hard to work out who the winners will be, because ultimately, at the end of the day, your revenue comes when they start producing, right? So you can have producers that you can pick up royalties on. You can have near-term revenue potential as well. Is that sort of near and dear to your heart in the sense like we got to be up that end of the buying versus exploration, or is it deliberately a kind of blended approach to this?
The quality of the management team is going to be paramount.
Right.
That ability to go and raise money, that ability to develop the asset is really what we look at. So ideally, that they're well backed, good team, proven experience in country and in the capital markets. And so really, very reliant on a quality management team. That leads our due diligence before we delve into the technical.
Right, okay, and so what's kind of holding you back? So here's the thing, because I think a royalty should be part of everyone's portfolio, right? But pick the right group. I'm going to be interested in dividends, so we need to talk about dividends in a second. I'm interested in the level of royalty, and I'm also interested in the relationship between what the company's being valued at versus that royalty coming in, because there's a kind of defensible, indefensible point there where you go, we're doing really, really well as a business, but we might as well be private, quite frankly, if the market's not going to reward us. Or you say, well, actually, we've become so attractive that someone's maybe be looking at us and going, quite fancy a lot of that revenue coming in here because the multiples aren't too egregious.
Yeah, I mean, the only defense against M&A is a high share price. I think certainly with these numbers and the significant growth that we're going to see in 2024, I would think that that would be reflected in the market, because we have seen a real compression in terms of multiples. We have seen, you know, when we listed in 2020, just the sector was just trading on higher multiples. So I think the only way around that is to demonstrate real revenue growth and then operating cash flow growth as well, so you can actually
okay, we got to get into this, because I think at the time when you guys were formed, it was a very excitable, bubbly, frothy market, and everything was overpriced, right? And royalties especially so. Some of the multiples that some of the bigger boys get, or what people chase, and some of the new entrants thought they would get there overnight. It didn't happen. So we need to look at how people should be. You told us what we should be looking at, but why should that be reflected in higher value and higher share price? Revenue is important, clearly. Why?
The key differentiator, I think, between us and really any of the precious metal royalty companies in that sort of sub-billion space where we play, I think it's just the quality of the operator. So if you look at the underlying assets, and really what you're investing in is you're investing in a very high quality royalty on Karlawinda, operated by Capricorn Metals. These are, you know, an incredible Australian management team, already demonstrating reserve replacement from their exploration. This is going to be a very, very long life mine with very, very high quality operators. Likewise on Caserones, recently Lundin Mining, you know, at a pretty significant valuation, came in to take 50% of the company. I'm sure they're going to take that option to take them 50%. They're now doing the first proper exploration program that mine's seen in years. And so you're really underpinned by these long life assets that have lives well beyond published reserves. So that means that even with 5 years from now, we would expect to have similar mine lives that's really underpinned by high quality assets.
Okay.
And that's our differentiating factor.
Right, but if you think about the type of shareholder that would, you know, invest in, because you're kind of derivative of mining, right? I'm used to, as an investor, investing into exploration companies who continually ask me for more and more and more money. They don't produce any revenue. Developers are saying they don't produce any revenue, and then you know, gold producers, gold producers in your case, they do eventually produce money, and they do eventually become economic, hopefully. You guys are producing revenue, right? You're taking a slice of, you know, off of these NSRs, these royalties, these streams, that you know, that you have, and you say, right, we are producing revenue, but people don't understand how to value. They don't understand why that's valuable. Maybe they need to see a dividend, a big dividend from you. So, right, if you're making money, reinvest 75%, give us 25% of that, and then I can sort of understand what that arbitrage stream, you know, crediting you with some, you know, future value looks like, because I'm getting something today as well. It's kind of, do you know what I mean? Why should people buy royalties, I guess?
I guess two questions there. So we paid a dividend when we were a private company, so pre-listing. Feedback we had from our material shareholders is they would rather us deploy that capital rather than, you know, shareholders have never suggested they want the money back directly. So I think that's why you invest in a royalty company like us, is our ability and our demonstrated ability to redeploy that capital accretively. So
great for the company. What do I get out of it? Why is it going to drive the share price? Why should that drive the share price? That's the bit that's missing in the, like doing it when you're private, early days, of course, redeploy the capital. I don't need it now. You've got to have a good run. You know, I'm going to give you the space to have a good run at this market. The company has continued to deliver quarter after quarter after quarter, coming from, I think when we first talked about 5 million in revenue up to, we say 17.9, something.
7.8, yeah.
17.8, right? Okay, and continuing to deliver, but which is great because it makes the company sound powerful, but it's not getting that reflected in the share price. People aren't piling in like they should. It's complicated, right? So,
it is and it isn't. I think what will be reflected is some of the acquisitions that we've done, certainly over the last 18 months. I'd take case in point our acquisition of our Cactus royalty on Arizona Sonoran's mine in Arizona. I think to pick up royalties and to be able to continually acquire high quality royalties at deep discounts to NAV, that when those assets, which I think of a phenomenal management team, well backed, well covered, advance along the development curve, then that should be reflected fully in our valuation.
It should be, but it's not happening across the sector at the moment. So yeah, I think that the equation I'm trying to work out is, right, I've made a bunch of money, am I going to go and spend it? And when that will make some money, and then I'm going to go and spend that. It's like, well, what have you done for me lately? I think is what in the mind of investors, retail, and go, well, how does that constant spending of money on projects for the company help me if we don't know how to value that transaction?
I completely understand, but I think we are a very counter-cyclical business. Like, we definitely benefit from the capital markets being as challenging as they are. Like, we are not
in
unique.
terms of acquisitions.
Absolutely,
Right.
and that's what you are buying with Elemental Altus is our ability to execute on those. So the tougher it is that even very high quality companies are now exploring royalty finance. Even high quality Australian companies are exploring royalty finance, which never used to happen.
So, okay, we're getting to it now. We're saying, so we're in a moment of the market where there's deals to be done, right? This is the moment we live and die by. We're doing good deals, good transactions with companies who are finding it hard or expensive to access alternative financing or cheaper financing. So right now we're in acquisition mode. There will be a moment when the markets return where we're not going to be doing any buying because it doesn't make any sense for us. That's when we can look at what we do with our capital.
And we have been very prudent. So 2021, for example, there were a lot of new entrants in the space, a lot of new entrants in the public space. I'm sure you met a few of them. We'd just done our big acquisition from South 32. We're waiting for Karlawinda to come online. Yet we didn't need to go and chase, revenue for revenue's sake. We were very prudent about what we were doing. And I think that's paid dividends. That has actually shown that was the right approach. Now I think we're in a very different point of view, and we're getting a lot of inbounds, most of them not suitable for us, but we are certainly, one of the reasons why we're here at the conference is to follow up on those, on some of the higher quality ones, and look to redeploy it, because again, we're only a $150 million market cap with available liquidity of more than $30 million, and that's growing probably by $15 million more every year. So we think we're in a really exciting point.
Right, but that's in terms of building up the portfolio. So I'm pushing on this one, but I really do need to understand. Like, if I'm invested, I get it. We're in buying mode at the moment. It makes sense to do that. It's going to be the cheapest we're going to get, the best deals we're going to get. Once we kind of get back into a slightly different space where the market's a little bit more frothy, etc., all equities, one should imagine, will change because we'll new money coming in. But you as a company, what do you do for me? Is that a moment where we get dividends because you're not buying? We've got big pools of cash coming in. You've got these annuity streams of whatever the life of mines are. Do I get some of that?
Yeah, I think we've always thought that once we've got to sort of operating cash flows to where they are now, that the dividend could definitely be contemplated. Most of our peers above a certain size pay a dividend, and it is a modest dividend, I guess, for the royalty companies. But my view has always been that it's very prudent, corporate governance to contemplate returning capital to shareholders, whether that's in the form of dividends or share buybacks.
Share buyback, okay, fine, okay. Yeah, the market has been sort of 1.5% type level, so it's not masses. I might think, I keep my money in the bank. So the real gains are going to come from when the share price starts moving, when the market comes back. That's where I'm going to see the gains.
Definitely. So get a return on some of the high quality investments that we have made and that we will make, and really I don't want to say take advantage, but look at when valuations are compressed, when capital is hard to come by, that we have significant resources to deploy.
Do non-royalty streaming companies buy royalty and streaming companies? Because do you know what I mean? Because I think if you're all in the same boat, you're sort of defensible in the sense that not many people in your game have got much spare cash.
I mean, we're going back a long way, but Newmont did buy Franco, didn't they?
Yeah,
and then spun them back out again in 2007. So it has been done. I mean, unusual, I'd say. Yeah. But I say precious metal company with our yields is reasonably unusual. So I think you've got to be looking over your shoulder a little bit.
I know, and that's mainly sort of that whole defensible thing versus we want to time it, but you don't necessarily always get to time it. You've been through one, hostile sesh, which is rather unpleasant, and it probably would have been absolutely the wrong deal. Definitely would have been the wrong deal for you guys, looking at where you are today.
I think actually the one thing that we agreed completely with about the hostile was consolidation in the space needs to take place. There doesn't need to be this many junior royalty companies. There doesn't need to be this many management teams. So we are always looking for opportunities for consolidation and looking at different contributions and different synergies. So yeah, obviously a bit more grey hair than when we started post-hostile, but no, definitely we're very supportive of consolidation in the space.
Right, okay. Well, look, Thanks for coming in. It's a nice, short, sweet one. But you sound quite. It sounds quite aggressive. We're going to get out there. We're going to do some deals. Yeah.
It's. I honestly, the company's never been in a better place. We're genuinely excited for this year.
Yeah. No, I like it. Get out there. Do
Pleasure.
deals.
Cheers,
Okay,
mate.
see you
Good
soon.
to see you.
Thank
Absolutely.
you.
Cheers.